You have to know. You have to know. You don't want to answer me or what?
You
You have to know.
You have to.
We go to chapter 13 in economics, indirect taxes and subsidy. We'll talk about, before I go into indirect taxes, what is a tax? A tax is a levy imposed by government on production and consumption. That's what a tax is. We call it a levy because we have to pay it. It is compulsory. Then, if you don't pay it, that means you are going against the law. That means you are evading tax, which is not something that you do. So the point is, government taxes are meant to be paid. So we have two forms of taxes. We have direct taxes and indirect taxes. For direct taxes, we're talking about taxes on our income, taxes on our wealth, taxes on profits. But that's not where we're going today. We're going to indirect taxes. For indirect taxes, we call them taxes that are based on, that are charged on consumption. That's what an indirect tax is. On consumption, yeah. So for indirect tax, we have the VAT, which is the value-added tax or ad valorem tax. We call it VAT or ad valorem tax, which is value-added tax or ad valorem. Then we have the excise duty. So what makes them different? For the value-added tax, it is charged on the value of the goods. So whatever goods we buy, the value of the goods we bought, taxes are on them. That is VAT. Do you get what VAT is here? The value of the goods you bought will be charged, will be what taxes will be upon. So if you have bought goods worth of $500, the VAT will be on the $500. Maybe 5%, maybe 2%. It depends on what the government wants anyway. Do we understand? So that is about VAT. Any question about VAT? Good. Then we have excise duty, which is a unit tax or specific tax. On that one, it is charged on the volume, not the value. So the difference between value-added tax and excise duty or unit tax is that for value-added tax, we charge it on the value of the goods. For custom duties or specific tax, they are based on the volume of the product. Do you get the difference here? Volume means the quantity. The quantity. Do we get it, please? Do we get it, please?
Yes.
So we have subsidy. What is a subsidy? A subsidy is a financial help from government, which helps production or consumption. So if subsidy is given, it means government is trying to reduce the cost of production for firms. And if this happens, prices becomes affordable for consumers. Get the point? Government will help firms by reducing their cost of production. If the cost of production for firms reduces, it means they can supply more to the market. And if they are able to supply more, it means the prices will afford it. So that's why subsidy will help both consumption and production and consumption. Is it clear? Yes. Any question about that? So go to the incidence of tax. For the incidence of tax, we're talking about who takes the tax burden, who shoulders the burden of tax. That's what incidence of tax is. Do we understand incidence of tax? Incidence of tax. Do we understand or not? No. We call it incidence of tax because it becomes a burden. Who bears the burden? So that individual, the taxpayer, that is it. So the individual who pays that tax, the individual or the firm or the business that the tax is affecting takes the burden. So that's what we call tax incidence. Incidence, it happens, it affects you. It has impacted in your profits or your income. That's why we call it incidence of tax. So the taxpayer has the tax burden. It shoulders the tax. It shoulders the expenses. That's why we call it tax incidence. Is it clear? Yes. Is it clear now? Yes. So, an imposition of indirect tax. As soon as an indirect tax is imposed, it has an implication on supply. An increase in indirect tax will shift the supply curve leftward or upward from S2 to S1. At that point in time, we're going to have a high equilibrium price. Get the point here? An increase in tax, imposition of tax, will bring about an upward shift in the supply curve or a leftward shift in the supply curve from S2 to S1. As soon as this occurs, it contracts the demand curve. The demand curve will move upward. Do you get the point here? And if the demand curve moves upward, it means it reduces the quantity demanded in the market. Why is the quantity demanded reduced in the market? It will reduce because we're going to have a high equilibrium price at P1. A leftward shift or upward shift will contract demand and increase the price of the product. So we're going to have a high equilibrium price at this point.
Yeah, it even increases Q2 to Q1. Can I say that?
No, it reduces the quantity supplied.
It reduces. Can I say that?
Yeah, because S2, S1 represents quantity.
Okay.
Do you get the point here? A tax imposed on indirect, an indirect tax imposed will increase the cost of production for firms. Because they cannot always increase price. The first thing they would try to do is to reduce the quantity supply in the market. So as soon as quantity supply reduces in the market, the quantity demanded will contract. There will be movement along the demand curve for the quantity. So to move upward, contracting from this point to this point, which reduces the quantity. Quantity has fallen from S2 to S1. Quantity demanded has also contracted from Q2 to Q1. Then we're going to have a high equilibrium price. That is the implication or the consequence of indirect tax. Fine. Is it clear?
Yes.
Do you understand, please?
Yeah.
So that is its implication. Now, who pays for this tax? No, it's not always going to be consumers paying. Producers might also pay. This is the point. As soon as indirect tax is charged, we try to find out the kind of product it is. Is it a product that has a price elastic demand or inelastic? If it's a product that has the demand to be priced inelastic, consumers might actually pay all the tax burden. The burden might be on the consumer's shoulder if the product is priced inelastic. But if the product is priced elastic, it means both consumers and producers will share the burden. Do we get the point I'm making here? There's the tax burden, which increases the price. The high price, which is as a result of an increase in taxes, could be a burden on consumers and can as well be a burden on both consumers and producers. What would have caused it to be a burden on consumers? If the price of the product is inelastic, that means irrespective of the price, consumers will still pay. Then the burden or the tax incidence is on the shoulder of consumers. But if, on the other hand, the product is priced elastic, it means you cannot simply increase the price. Both consumers and producers will bear the burden. Do we understand incidence of tax here? There's incidence of tax, which means there's a tax burden on taxpayers, based on the fact that the taxes or indirect tax has been imposed. So an imposition of indirect tax, like here, an imposition of indirect tax will increase the equilibrium price. A higher equilibrium price could be paid by consumer or both consumers and producers. It will be paid by consumers if the demand for the product is priced inelastic. It will be paid by both consumers and producers if the price of the product is, if the demand for the product is priced elastic. That is what tax is about. Is it clear? Any questions about it? We'll stop here.